Module Overview GIS. Cash flow estimation is the backbone of capital budgeting analysis. Without reliable projections of a project's inflows and outflows, even the most sophisticated evaluation techniques, NPV, IRR, payback, can become meaningless or misleading. In this module, we delve deeply into how to identify, estimate, structure, and evaluate project cash flows, ensuring all relevant components, initial outlays, operating inflows, terminal values, tax impacts, depreciation, working capital, etc., are properly accounted for. We also explore real-world considerations, such as inflation, foreign exchange risks, opportunity costs, and externalities. Principles of relevant cash flows. Only cash flows that change as a direct result of accepting the project should be included in the analysis. These are known as incremental cash flows. Included: initial capital investment, operating cash inflows, outflows, terminal value or salvage changes in working capital tax effects, depreciation for tax purposes. Excluded: sunk costs already incurred, allocated overheads unless avoidable, financing costs captured in discount rate. Components of cash flow estimation: WATs. 1. Initial investment outlay. Includes all cash expenditures required to bring the project to an operational state. Capital cost of fixed assets, installation and testing costs, initial working capital requirements. Less: salvage value of old assets, if replaced. Example: buying machinery for $300,000, installation cost $20,000, working capital of $50,000, total initial outlay, thus $370,000. 2. Operating cash flows, years 1 to n. Operating cash flows are calculated using the after-tax operating profit plus non-cash expenses, e.g. depreciation. Formula: operating cash flow, revenue operating costs, depreciation x 1 tax rate, plus depreciation non-taxed operating cash flow, as revenue operating costs, depreciation, and times 1 tax rate, plus depreciation reflects ongoing profitability. Taxable income is adjusted for depreciation, non-cash, often projected over 3 to 10 years depending on project life. 3. Terminal year cash flows. Includes the following at the end of project life: salvage value of fixed assets, recovery of working capital, tax impact of asset disposal, gain loss. Example: if asset salvage of $40,000, book value $30,000, tax rate 30%, tax on gain $3,000. 4. Working capital adjustments. Working capital is invested at the beginning of the project. It is recovered at the end of the project. It is not depreciated. Note: changes in working capital affect annual cash flows too, if there are increases, decreases over time. Incorporating depreciation for tax shield. Although depreciation is a non-cash item, it provides a tax shield by reducing taxable income. Common methods: straight line, equal depreciation annually. Declining balance, higher depreciation in early years, tax shield. Depreciation x, tax rate. Example: asset $100,000, life 5 years, tax rate 30%, depreciation year $20,000, annual tax shield $6,000. Inflation and real versus nominal cash flows say. To maintain consistency, use real cash flows with real discount rate or nominal cash flows with nominal discount rate. Nominal flows include inflation expectations, more realistic in long-term projects. Real flows excludes inflation, used for comparisons or theoretical exercises. Mismatch between the two leads to incorrect NP. Foreign investments and exchange rates. For multinational capital budgeting, forecast cash flows in local currency. Convert using projected exchange rates. Adjust for political risk, currency control, inflation differentials. Include repatriation costs, withholding taxes, and foreign inflation. Common errors in cash flow estimation, including sunk costs, excluding opportunity costs, ignoring working capital, not adjusting for inflation, double counting depreciation, using accounting profit instead of cash flow, overestimating salvage values. Opportunity cost, value of benefits foregone by using resources in the project rather than their next best use. Example, using land already owned, no cost, still has opportunity cost equal to its rental value. Externalities. Indirect effects of a project, positive or negative, that aren't captured in direct cash flows. Examples. Launching a new product cannibalizes existing product sales, negative externality. New showroom increases brand visibility for other product lines, positive externality. Scenario analysis and sensitivity testing. Cash flow estimates are based on assumptions that may change. Sensitivity analysis. Tests effect of changing one variable, e.g., sales volume. Scenario analysis. Tests multiple variables together, e.g., best case, base case, worst case. Simulation. Generates probability distributions of outcomes. These tools help mitigate risks and prepare for uncertainty. Example, cash flow, forecasting simplified. 1 year, 2 revenue, 3 operating cost, 4 depreciation, 5 EBIT, 6 tax, 30%, 7 net income, 8 CF, 100,000, 40,000, 20,000, 40,000, 12,000, 28,000, 48,000, 2 120,000, 50,000, 20,000, 50,000, 15,000, 35,000, 55,000, 3 130,000, 60,000, 20,000, 50,000, 15,000, 35,000, 55,000. Summary table, cash flow components in capital budgeting. Component description. Include initial investment cost to start the project, operating CFs. Annual cash inflows from operation depreciation, non-cash, but creates tax shield sunk costs. Past costs already incurred. Financing costs captured in discount rate. Working capital cash tied up in operations. Salvage value cash from asset disposal externalities. Indirect impacts, if measurable. Inflation price level change over time.